Everyone has their own idea of what financial success means. For some, it's having enough money to take care of their families and live comfortably. Others might feel financially successful if they can retire debt-free, while some think it means having millions to give away. No matter how you define it, being financially stable removes a lot of stress. It means not having to worry about how your family will eat or where they will live, lifting a huge weight off one's shoulders. The good news is that there are systems and strategies to help you achieve financial success. One way is by investing in assets that increase in value over time. Knowing the right assets to invest in requires knowledge, values, balance, and clear goals. Follow along to learn about different kinds of assets you can invest in to gain financial freedom. Before we get into the video, give this video a thumbs up for the YouTube algorithm. Now, let's get into it. 1. Bonds. A bond is essentially a loan from an investor to a borrower, often the government or a corporation. The borrower agrees to pay back the loan with interest over a specific period. Bonds provide a fixed income, with interest rates that are always fixed, so you know exactly how much you'll get when the bond matures. This predictability makes bonds a secure way to grow your wealth. However, not all bonds are created equal. You need to do your due diligence when picking a bond. Government bonds are generally safer than corporate bonds, but they may offer lower returns. Corporate bonds can provide higher yields, but come with higher risk. By researching and selecting bonds that fit your investment portfolio, you can ensure a steady income stream and financial growth. 2. Stocks. Stocks represent ownership in a company. When you buy stocks, you own a piece of that company and share in its profits. Stocks are usually bought and sold on stock markets, such as the NYSE, Nasdaq, or London Stock Exchange. The value of your stocks can rise and fall based on the company's performance and market conditions. Investing in stocks has the potential for high rewards. If the company does well, the value of your stocks can increase significantly, and you can earn substantial dividends. However, stocks are not immune to market fluctuations, and their value can drop. To mitigate risks, it's wise to diversify your stock investments across different sectors and industries. This way, if one company or sector underperforms, your overall investment portfolio remains balanced. 3. Real estate. Real estate includes land and anything permanently attached to it, such as buildings. It's one of the highest appreciating assets, meaning its value tends to increase over time. People build wealth by buying and selling real estate, developing properties, or renting out residential and commercial spaces. Investing in real estate can provide a steady income stream through rental income and long-term capital appreciation. However, real estate investments require significant initial capital and thorough research. Property values can be influenced by location, market trends, and economic conditions. It's essential to understand these factors and conduct due diligence before investing. Despite these challenges, real estate remains a reliable way to build wealth. 4. High-yield savings account. A high-yield savings account offers a higher interest rate compared to regular savings accounts. While it comes with more risks, understanding these risks and researching legitimate players in the market can help you gain financial freedom. High-yield savings accounts provide better returns, making them an attractive option for growing your savings. Interest rates on high-yield savings accounts are influenced by the overall economy. In times of economic growth, these accounts can offer impressive returns. However, during economic downturns, interest rates may drop. It's crucial to stay informed about economic trends and choose reputable financial institutions to minimize risks and maximize returns. 5. Collections. Collecting valuable items like wines, fine art, and vintage cars can be a lucrative hobby. Although predicting future prices can be challenging, with research, you can get a good idea of what similar items are worth. Collections can be valuable assets that produce wealth at the right time. The key to successful collecting is to focus on items that have a history of appreciation and a strong market demand. For example, aged wines and spirits, renowned fine art pieces, and well-maintained vintage cars can fetch high prices in the market. Building a valuable collection requires time, effort, and knowledge, but the rewards can be substantial if you choose wisely. 6. Certificate of Deposit, CD. A certificate of deposit is a bank-issued certificate for a deposit held for an agreed period at a fixed interest rate. This low-risk investment helps your money grow over time. Ensure the bank has insurance on deposits to protect your money. CDs are a safe and predictable investment. When you purchase a CD, you agree to leave your money with a bank for a specific term, ranging from a few months to several years. In return, the bank pays you a fixed interest rate. The longer the term, the higher the interest rate typically is. While CDs offer lower returns compared to other investments, they provide stability and security, making them ideal for conservative investors. 7. Mutual funds. Mutual funds pool money from multiple investors and are managed by a fund manager. They invest in assets like treasury bonds, stocks, and other appreciating assets. Mutual funds offer diversification and can be easily purchased through brokerage firms, making them an attractive option for increasing wealth. Mutual funds provide access to a diversified portfolio without the need for individual investors to manage their investments actively. Fund managers select a mix of assets to maximize returns while minimizing risks. Mutual funds can focus on various sectors, geographic regions, or asset types. This diversification helps spread risk and offers potential for steady growth, making mutual funds suitable for both beginner and experienced investors. 8. Private equity. Private equity involves investing in privately owned companies. It offers better returns than public equities and allows you to get an ownership stake in a business. Although it requires significant investment and careful research, the rewards can be substantial if you pick the right private equity. Investing in private equity means providing capital to companies that are not publicly traded. These investments can include startups, expanding businesses, or established private companies. Private equity investors often take an active role in the management and growth of the business. While private equity can be riskier and less liquid than public equity, successful investments can yield high returns, making it an attractive option for those with the capital and expertise to invest wisely. We all have opportunities to invest in assets that can improve our lives and provide financial freedom. Stay encouraged to invest wisely and gain financial success. Thank you for watching.